All right, guys, it's very well known that Berkshire Hathaway has crushed the market since Warren Buffett took over. And this is also going back to 1965. Now, there are a lot of misconceptions when it's beating the market, and it's also changed as of recently, right? So Mo, when you heard Berkshire Hathaway beat the market, what was your understanding of that?
That the average of all of their stocks put together in their Berkshire ETF kind of thing,
yeah,
they all beat the market as a collective whole.
So how do you account for his private businesses?
I don't know. Because you can't.
Right. I mean,
you can't.
So here's
how many private businesses?
90.
Yeah. So,
but early on, in his early days, he didn't buy businesses as a whole.
Yeah.
He would buy only stocks, and he crushed it. Yeah. And if you go look at his earlier annual reports, he'll show all of his returns and things like that. Now, here's his most recent one, full year annual return in per share market value of Berkshire. And I wanted you guys to see, like, the stock has fallen a lot in years. Now, it is impressive how it's done very, very well. Look at it this way. 1966 was the peak of that previous secular bull market. And it bottomed out in 1982. I mean, he crushed the market then, 102% in 1979. But I don't know why he changed it recently. My guess is SEC rules. But if you go to before, back to 2018, let's go back to his annual report in 2018.
And I bet you, because he's pretty transparent in his annual letters, I'm sure if you go and read his annual letter, he'll explain exactly why.
Probably.
Yeah.
So let's look at this. And this is the interesting part. He always went on book value per share. What's book value? Assets minus liabilities, essentially stockholders' equity. That's how he calculated the value. And the impressive part is, look at how much it beat the S&P. And this is the S&P with dividends included before taxes. This book value per share is after he's paid taxes. Wow. And look at this, 18.7% per year versus 9.7% at that point in 2019. And the stock had done 20.5%. That's the impressive part. And don't forget also, the book value per share, I don't think accounts for increases in the value of the businesses that he owns fully. Because think about it. How do you put that on a balance sheet?
Yeah, you can't. I mean, you can't.
Unless the transactions occur. I mean, unless you put a fair market value adjustment, which I don't think the SEC would allow, because I think you have to hold it for what you're into the investment for.
Right.
So this doesn't even include when you bought See's Candy for $25 million, and now who knows how much it's worth? Right. Hundreds and hundreds of millions, not billions of dollars or whatever it is. Now there is some, go ahead.
And to think of how much money he has to allocate to still beat by this much.
Correct.
He said if I had $1 million, I could do 50% a year.
He said, his exact quote was, I think I could. Nope, I guarantee I could. Yeah. He literally said those words.
And guys, it is very difficult. The more capital you have, the harder it is to beat.
Of course. And the reason being is if you find a great if you have $100 billion in cash and you find a great $50 million investment, even if it goes up 10 times,
what's it going to do?
It's only going to add 0.5%, not even.
Not going to move the needle.
Yeah, it's not going to move the needle at all. So it's harder as time goes on. Now, Warren Buffett's also used leverage. What's his leverage he's used?
What is his leverage? I don't know.
Insurance float.
Oh, okay. Good call.
So remember, insurance float is when we pay premiums for your insurance companies assume they're going to pay all of that out at some point in the future. Mm-hmm. But in that time frame of which they wait from paying it all out, what do? They invest the money at higher rates of return. And that's the goal. So not only in insurance do you need to be a good underwriter who can properly assess how insurance is paid out, et cetera, you also need to be a great capital allocator. So essentially, Warren Buffett has used the leverage. It's very cheap leverage, but he has used some leverage. He's taken money that he owes out in the future and uses it today to invest. Right. You know, for a lot of our real estate deals, insurance companies lend that money out. Why? They're like, hey, listen, we have all this money coming in. We might as well lend it out at 4, 5, 6, 7%, whatever the rate is, because we're paying hopefully 0 or very low percentage. Right? Now, Warren Buffett, if you read his annual reports, he will discuss how it's very important that the cost on the insurance be 0 or positive.
I remember reading that one.
That's very important for him. Yeah. But the big key here, I want to show you guys, in his history of book value per share, there's only 2 negative years. And what were they? 2001 and 2008. And in those years, ironically, the stock went up there, but it went down big time here. Okay? Now, I've always talked about this because Warren Buffett really looks at book value per share for Berkshire Hathaway. He always says, if I can buy Berkshire stock back at less than 1.2 times book value, I'm going to buy shares back. And we did a video. I don't think it's been released yet. If it hasn't been, go watch the video about how we value Berkshire Hathaway, because it's a lot different than other companies. And the reason being is he's got such a big stock portfolio that the SEC now requires him to put any gains or losses in the value of the stock as bottom line net income numbers, which he's against, Munger's against, I'm against. It's not an accurate reflection of it causes earnings to fluctuate too much.
Right.
So in order to properly evaluate Berkshire Hathaway, you need to focus on cash flow and book value per share. But this guy has absolutely crushed the market. Absolutely crushed. Even the book value per share. It's incredible. Look at these years. When I hear people criticize his returns, I'm like, you're stupid. Look at this. 2018, 0.4. S&P was down 4.4. I mean, all these differences along the way, I'm looking at going, how dumb do you need to be to really question Warren Buffett's abilities? Now, is he going to do well in the future? I mean, relative to the market, is he going to be able to crush by how much he's crushed by?
No.
It's going to be...
I doubt it.
I mean, look at it this way.
I doubt it for a couple of reasons. I would doubt it, one, because of how much money they have, and number two, he's not going to be around.
Well,
so I'm curious to see if there's a shift at Berkshire.
I think people are going to blame. I don't think the issue is him not being around. I think the issue. I think he's done a good job of finding like-minded investors.
Put in his place.
Correct.
Him and Charlie's place.
The hard part is when you have $100 billion or $200 billion in cash. How do you possibly? You have to only invest in very, very large businesses, and the larger and larger the businesses, the less opportunity there is for mispricing.
Do you know if they've ever had this much cash, held this much cash?
No, I mean, I think they've. I mean, we can look at their. Let's look at their stock. Let's look at our software.
And
here.
I'm only wondering because I want to look back and say, hey, if they ever had $100 billion in the past, which I don't think they did. Let's see how they did during that time.
Right. I don't. Let's look at the balance sheet. Oh wow, they had 146. Well, let's go to yearly. No, it's pretty much been growing every year.
Okay.
I mean, this is their annuals. 83, 77, 91, 97, 86, 115.
Yeah, so it's going to get harder.
It's going to get a lot harder.
The more that cash goes up, the harder it becomes, for sure.
And when I hear people say like, oh, Warren Buffett's a has-been, I'm just like, okay. Like, this is absolutely ridiculous to even say that. You know, I watched a great video of him, and this is a quote that I'm going to steal. And I sent it to Mo and Tim. You know, people always accuse me of being too conservative. Like, oh, you're sitting on cash. It's a terrible investment. I'm like, okay. But the one thing I like, the analogy he made was, listen, I'm a basketball coach. I'm trying to find 7-footers. If a 5-foot guy comes to me and says, hey, watch me play, you'll be really impressed. I'm a great 5-footer. I'm sorry, I don't want to waste my time. You can very well be a great, but I'm here to focus on the obvious ones. I'm going to find the 7-footers and then find out, okay, which ones can dribble well, which ones can shoot well, which ones have the abilities I want.
Which ones have the coordination to make it happen.
Coordination was what he said. Yeah. Exactly. Same thing here. When I look at an investment, my goal here is, you know, we have a lot of reinvestment opportunities. Warren Buffett does too, because he has 90 whole businesses he owns wholly. So he can sit there and say, if one business says, hey, we have an opportunity here to get a 20% return by investing $1 billion, Warren Buffett has the ability to say, there you go, there's your $1 billion. Yep. We have that ability, not at the same level, but we have a lot of real estate. We have a lot of businesses. We can reinvest at much higher rate of return. So when people pitch me a deal, I got pitched a land deal 2 years ago, 3 years ago, 2 years ago, the guy said, yeah, it's pretty much a guaranteed 10%. I said, first off, no such thing as a guarantee. And secondly, 10% doesn't get me out of bed. Why? I can invest in my real estate deals and make 15%, and I own those deals, and I'm investing in myself.
Plus, you can throw whatever that money is into an ETF and say, oh.
Well, not even an ETF. Forget about that.
That's the most simple way, though.
I can do options and make 7 or 8%. Yeah. So why would I?
What's the point?
Why would I put it in a deal that if it goes poorly, I'm going to end up in legal battle, more costs. If it goes well, I get 10%, or I do my own investments.
Yeah.
It does. So that's what Warren Buffett's big advantage in life is. He's patient, and his disadvantage now is he's so good at investing that he has a ton of cash. So right now, with $147 billion invested, how do you grow that? You grow that by deploying 30 or 40 billion at a time.
Yeah.
That's how you deploy it, right?
And so good luck finding those opportunities.
Correct.
That's the hard part.
And I'm willing to bet, guys, if you ran the numbers here, as time goes on, I mean, let's go back and look. As of 2018, his returns, book value per share, was 18.7%. book value per share growth. Let's go back to 1995. What was it at that point? Oh, he didn't report the overall. There's got to be some sort of reporting overall. I assure you, though, it was well over 18.5%. Well over. I mean, look at this. We could do the math. Let's see. Let me find a year.
What year are you looking at?
Go to 1995. I'm going to go to 1998 real quick. I'm sure there's something here in 1998. Oh, F off, Warren. That's so funny. See, look right here. He writes, the S&P numbers are pre-tax, whereas Berkshire numbers are after tax. So let's see here. Let's go down. Yeah, so the bottom line is, as time goes on, his overall return will probably decrease. Now, do I still think he can beat the market? Yes, because he's not a multi-trillion-dollar cash holder right now, right? And at the end of the day, in the future, he could always put the money in ETFs, and if he really wanted to, he could. Yeah. Or what I think is going to happen, he's going to deploy it back out as dividend. At some point, Berkshire is going to say, we got to pay dividends out. At some point, because if they're not able to get excess return on the market, they've got to pay dividends out.
Shareholders.
So remember, going forward, when somebody tries to criticize Warren Buffett, I understand. But the only criticism of Warren Buffett is because of how good he is at investing. It's hard to deploy $150 billion in cash and get outsized returns. If you told me right now, Paul, make 40%, I'd buy a single family home and flip it. If you said to me, Paul, here's $100 million, make 40%, I'd be like, I can't do that. Yeah. I can't do that. That's just too difficult. Mm-hmm. That's the point. But everybody in this world is so obsessed with getting more and more assets. That's why I like Gary so much. Gary says, hey, Paul, at a certain dollar amount, I'm not taking on any new investors because then I can't get my returns I want to get. So guys, thanks very much. If this made sense to you, we have over 1,950 videos on our channel. Keep watching them, check them out, and subscribe to our channel for future updates. Thanks very much.